Okay, Chapter 4, we're going to be focusing on consolidated financial statements when there's less than 100% ownership in the subsidiary. So we're looking at outside ownership. This is called a non-controlling interest. It used to be called a minority interest, but they changed the verbiage to be non-controlling interest. So it's that part of the company that the parent doesn't own, meaning that part of the subsidiary. And here we go. Although most parent companies do possess 100% ownership, a significant number establish control with a lesser amount of stock. Remember, you only need 51 votes, or 51%. If the parent doesn't own 100% of the company, who owns the rest of it? Non-controlling shareholders. And that makes sense. They don't have control of the company, but they still are owners. The ownership interests of the non-controlling shareholders will be reflected in the consolidated financial statements. So we still do consolidation accounting, consolidated financial statements. Now, the parent with controlling interest must consolidate 100% of the subsidiary's financial information. So what this is saying is the acquisition method, the method we've been learning all along, requires that the subsidiary be valued just like we always have, as if it was a 100% purchase at the acquisition date at fair value. Then the total acquired firm fair value in a partial acquisition is the sum of how much the fair value of the controlling interest is and how much the fair value of the non-controlling interest is at acquisition date. Now here's the key. The acquisition method says, hey parent, you're really buying 100% of the assets and liabilities of the company. You have control of those. However, your equity is still split. Now when it comes to the fair value, we're going to approach it in the same manner, but you'll see when we do amortization, we won't use the 100% amortization for the parent company because they don't own 100%. So it's weird, I know, but the fair value will be used in acquisition, but when it comes to amortizing the difference between book and fair value, before we amortized 100%, now we won't. So that's one major difference. Assume Parker Corporation wants to acquire 90% of Strong Company. Now these are in your book as well. Paca was Paca. It's on page 148. They want to acquire 90% of Strong. Strong stock has been trading for around $60 per share. But Parker has to pay an amount above market value, or what we call premium, for the shares to gain control. So the shareholders say, hey, it's trading at 60, but I'm not selling it to you at 60. If you want to control the company, you got to give me 70. If Parker pays $70 per share to induce enough stockholders to sell, how will the 10% of Strong that Parker does not own be recorded? Now, this is one of the first hurdles. How do we determine the fair value of the non-controlling interest? Because we have to record everything fair value, remember. Now, Parker purchased 9,000 shares at $70 a share, so they're paying $630,000 in consideration. The remaining 1,000 shares trade at $60 per share, indicating that the fair value of the rest of the shares is only 60 grand. So the total acquisition date fair value, the total consideration given, would be $690,000 for all the assets and liabilities of the subsidiary. Even though you're not buying the non-controlling interest, you have to value it at fair value and include it because it's assumed the parent is really taking control of all the assets and liabilities. Now, we would take the $70 a share times 9,000 shares, and then the fair value of that, and the total fair value then of the subsidiary would be $690,000. That's a total consideration. Now, the total acquisition date fair value, the amount paid of Strong, is $690,000. That is greater then the fair value of the identifiable net assets acquired of $600,000. Now, these amounts are determined by looking at the number of shares that were in this quote purchase, 10,000 in total, the 9,000 owned by the parent, the 1,000 owned by the non-controlling interest. The fair value is truly $60 a share. So that difference of 90,000 has to be allocated to goodwill. But who gets the goodwill? The controlling, the non-controlling, or is it split up? And that all depends. The parent first allocates goodwill to its controlling interest for the excess of the fair value of the parent's equity interest over its share of the fair value of the net identifiable assets. Now, the fair value of the total company, the net identifiable assets, remember that's fair value of the assets minus fair value of the liabilities, would be the $600,000 times the parent's interest of 90%. So it would be $540,000. Strong paid $630,000 for the company. So they paid the full $90,000. So all $90,000 would be allocated to them. So it's not based on proportion of ownership. It's based on fair value of the portion of the assets and liabilities compared to what the consideration was given by both. The fair value of the net identifiable assets is allocated based on ownership percentage. So take a look at this one. Here, oh, I'm sorry, I thought that was a different example. And that's what we just went through. So there's no excess goodwill assigned to the non-controlling interest. So the parent will be including all $90,000 on their record. If the shares were not actively traded, the $70 per share consideration transferred by Parker would be considered the best measure of fair value of Strong, and the fair value of the non-controlling interest would be estimated at $70,000. And here's what would be. So this is when there's no market value. So you'll see this. Some subsidiaries aren't traded on the stock market. They're privately owned, and a company goes in and buys them out, buys out their shares, or so that they keep, maybe they purchase 9,000 shares and there's one owner that has the other 1,000 shares. So if it's not actively traded, we'll look at the consideration paid by the parent here. So Parker would be paying $70 a share. The fair value of the consideration given would be the $630,000. Then the non-controlling interest fair value would be $70,000. The $70 a share times 1,000 shares. Okay, so this is all in your book. So we're just trying to verbalize it for you and hopefully bring out some points that might be confusing. Now, when this happens, we still need to compute if there's goodwill. Remember, the fair value of the net identifiable assets is different than the fair value of the consideration. The fair value of the consideration is what they paid. And in that case, since in this example here we're looking at, if the parent paid $70 a share, we have to value the non-controlling interest at $70 a share because it's not traded on the market. We can't establish a market value. In the prior case, we could establish a market value. Now, when we're allocating goodwill, if there is any, we are going to look and say, okay, what's the fair value of the net identifiable assets? $600,000. How much does the parent own? 90% of them. So we'll allocate $540,000. For the non-controlling interest, there's a $70,000, and they own they are considered to have paid, quote, paid $70,000 for $60,000. So they're going to actually have goodwill assigned to them of $10,000 in the non-controlling interest area, and the controlling interest will have $90,000. Now, how do we record all this? So we got all these great numbers and information, but how do we record it? On the balance sheet, a credit balance account, it's actually in stockholders' equity, called non-controlling interest, will represent that dollar amount the non-controlling interest owns of the subsidiary. So you're going to see, we're still going to go through our elimination as we always have, as if we owned, 100% of the company. But we will end up doing some extra elimination entries where we establish the value of the non-controlling interest in the equity section on the balance sheet, because we don't own 100% of the company. I know it's odd, but that's how it is done. That's what the acquisition method tells us to do. So this account appears in the equity section of the consolidated balance sheet, as I stated, and is required by SFAS 160. Prior to that, we had a different way of doing it. Okay, we're focusing on Statement of Financial Accounting Standards 160. Now, what kind of problems come in when we have a subsidiary we don't own 100% of? Well, the subsidiary's net income, including that amortization due to the excess of fair value over book value, must be allocated to its owner, the parent and the controlling interest. So the parent doesn't get 100% of the net income and subtract all the amortization. It's divided based on ownership. To properly measure the respective equity in the consolidated equity entity, this is what we need to do. If you don't own 100%, you can't report 100% of the net income. So on the income statement, we're going to have an account called non-controlling interest in subsidiary net income. And that's going to represent that part of the shareholders, non-controlling shareholders, portion of net income allocated to them. It's created during consolidation, and we'll see it in our worksheet. So let's go back to Strong. Strong earns $80,000 in the first year, and there is a $30,000 annual excess fair value amortization based on the fair value of all the assets versus book value. Now, let me see if they actually, they just give us that, but we'll see it in our next example where this basically 30,000 comes from. So the subsidiary Strong's total net income is 80,000. We subtract 30,000 due to the amortization, an increase in fair value. So their net income is 50,000. 10% of that is allocated to the non-controlling interest. The other 45 would be considered an increase in the parent's investment account. All right, so the consolidation process remains substantially unchanged. As I said, we're actually going to add steps, not take any away or really change them. We consolidate the parents and the subsidiaries' trial balances as though the parent owns 100% of the company. So if you turn to page 157, we're going to be looking at an example of King Company and Pawn Company. King is the parent, Pawn is the subsidiary. King will be consolidating Pawn with Pawn. King only owns 80% of Pawn, but it is a subsidiary, not a fully owned one. They still will take 100% of their trial balance and combine it with their information as far as assets and liabilities go. Then, after we do our normal consolidation entries where we remove the subsidiary's equity, we write up the unamortized amount of assets or liabilities that were different at acquisition. We record amortization. We're then going to determine 4 new things. The first one is, in the subsidiary, what's the non-controlling interest in the subsidiary as of the beginning of the current year? So how much of retained earnings, basically, is for the non-controlling interest? Or what was their beginning balance? What was the sub's current net income? And how much of it should be apportioned to the non-controlling interest? How much of the dividends should be apportioned to the non-controlling interest? And then finally, what is their balance, subsidiary's balance, as far as the non-controlling interest goes at the end of the year? And we will make journal entries accordingly to create that as part of our elimination and consolidation entries. So we're going to go and use the example that starts on page 154. Actually, I think it starts before that. Yeah, it does. It starts on page 152. Assume that King Company acquires 80% of Pawn Company. So King's the parent, but they only own 80%. And they paid $9.75, or a total of $780,000 cash, January 1, 2012. The shares are trading at that amount right before and right after the acquisition. Now, why is that significant? Well, if you look in your reading, we didn't cover it here, but if you look in your reading, sometimes we'll see that premium happen, and meaning King could have paid $20 a share. So that amount, the 80,000 shares they bought at $20, would be their cash. But how much would we value the non-controlling interest? Well, we would look and say, okay, what were they trading for before the purchase on average? What are they trading for after? If it's not $20, if it was more like $9.75, that's what you use to value the non-controlling interest portion of this acquisition. So the total fair value of Pawn to be used initially in consolidation is $780,000, and then the remaining 20,000 shares at $9.75 each. I like to double check this just to make sure. So I grab my calculator, and I advise you to do that as well. Would be $195,000. So the total purchase, quote, fair value, if somebody bought this, if the non-controlling interest paid bought and King bought, it would have totaled $975,000. Now remember, we do that because we're consolidating all the assets and liabilities. So we are buying and have control, King does, of all the fair value of the assets and liabilities. Now here's Pawn Company's account balances. This is the company they just bought. So the book values are listed. You could see them. The fair value of those assets. Now the trademark has a $60,000 increase from book to fair. That's something we're going to have to deal with. The patent has a 20-year life, and that has an increase between book and fair value of $120,000. So we're going to have to amortize that. Now the trademark is indefinite, so that would be tested for impairment. But basically in this chapter, nothing's happening to it. The equipment decreased in value. We've seen this before by 10 grand. And then the long-term liabilities decreased 40,000 between book and fair value. Okay, so remember, those differences is what will be amortized depending on their life. So we got the patent 20 years, we got to amortize that. Equipment is 10, and then the long-term liabilities will be 8. Now, when King purchases, remember they're going to look and say, okay, how much was the total fair value at the date of acquisition of the subsidiary? Not the net assets, fair value of the net assets. What was the total fair value of the purchase? And we already figured that out. Between the controlling interest and the non-controlling interest is $975,000. Subtract from that the book value. So the excess of fair value over book value is $235,000. This is also in your book on page 153. Why was there that difference? Well, we've accounted for that. First, the trademark's fair value was higher by 60 grand, so that's 60,000 of it. The patent was higher by 120. So that's 120 of the difference. The equipment was 10,000 less, which would decrease that difference, but the long-term liabilities was 40,000 difference, but that is actually an add. So we said there was $210,000 of increase between book value and fair value. So the difference between the 235 and the 210 would be goodwill. Okay, and that has an indefinite life. Now that goodwill will be allocated. Now all the way over on the right, before we do that, let's take a look at the annual excess amortization. Now this isn't only to King. This is 100% amortization, as if King owned the whole company. They don't. They only own 80%. So that 6,000, 1,000, and 5,000 will be allocated each year between King and the non-controlling interest. Okay. Now, who will get the goodwill? Well, remember, we go back to the date of acquisition and we say, okay, what was the fair value at acquisition? Basically, what did the controlling interest fair value pay? $780,000. What was the non-controlling interest valued at? $195,000. What were the fair value of Pond's identifiable net assets? Well, they're $950,000. And that's on page 152. So if you take $950,000 times the 80% to King, $760,000 is their portion. The remaining 20% is to the non-controlling interest. So the goodwill will be divided up, $20,000 to King, $5,000 to the non-controlling interest. And that's how we divide the goodwill up. So, okay, we'll go to this in a second. What happens when you have this kind of situation? How do you do consolidation? Now what we're going to do is kind of take it to the next level in our slides here, and we're going to show you consolidation not in the year of purchase, but the following year. The first thing Pond Company must determine is the changes in retained earnings since acquisition. Now, in 2013, they tell us at the bottom of the page, net income for the current year we'll be consolidating is $90,000. The dividends paid $50,000, so there's an increase in the subsidiaries' retained earnings of $40,000. In the prior year, the subsidiaries' increase in retained earnings was $70,000. Now remember, that's 100% of the subsidiary. So we have everything in front of us. If King uses the equity method to account for the Pond Company subsequent to acquisition, remember back in chapter 3, internal accounting, they have equity method, initial outlay or part or initial, shoot, sorry, I couldn't remember it off the top of my head. I'm going to get to it though, so I don't say something wrong. Initial something, right? Initial value, and then the partial equity method. Well, King uses the equity method, so there's none of that other holuba messing us up here. So the consolidation process would be the same as if they owned 100% of Pond in the beginning. So at each consolidation, and worksheet entries S, A, I, D, and E are all prepared as if they owned 100%. And a column will be added to the worksheet to record the non-controlling interest in the subsidiary. So take a look on page 157. 157. And there it is. what we'll do, now this is, remember, the year after acquisition. The first entry that is made, entry S, and these are all on page 158 as well, so you can follow along. Entry S eliminates the subsidiary's equity and moves it and eliminates the investment in Pond Company on King's books, but it will also establish the equity, the non-controlling interest account on the books, on the entry. Take a look on page 157. I'm looking at this and it's driving me crazy on the screen. So let's take a look at entry S. We're going to eliminate the common stock of King Company, $230,000. You see the debit in the consolidation entry column. We're going to eliminate the retained earnings balance, $580,000. We're going to eliminate the investment in Pond Company. Okay, and that was at the date of acquisition amount. Date of acquisition amount, $648,000. Then we're going to establish the non-controlling interest in Pond Company as of 1/1 of 13. Now, how do we get that? Well, as of 1/1 of 13, I'm going to have to take it back. Take a look on page 156. The non-controlling interest as of 1/1 of 13 would be the book value of retained earnings plus common stock. So that would be the 580 plus 230 times 20%, and that gives you the 162. If you take that times 80%, it gives you the 648. So that's entry S. The next thing we have to do is entry A. Now we do that by, remember, that's the unamortized balance as of the beginning of the year without any amortization for the current year in it. Now take a look here. A, on page 157, we're going to increase the trademark, debit that account 60 grand, right? Because remember, that difference is not amortized. However, the patent technology was amortized for 1 year already, last year. So its current balance, still to be amortized, would be $114,000. Because all $6,000 was amortized, partly by the controlling company King, and part of it was allocated to the non-controlling, but all of it was amortized. The equipment account will decrease credit $9,000 because remember, its original decrease was 10, but 1,000 of it was amortized. And then the where's that liability? There it is. Long-term liabilities, that will decrease by 35,000 because the original difference, remember, it didn't increase in fair value, it decreased in fair value, was 40 grand, but we amortized 5,000 of that last year. So the unamortized balance, which is what we're doing here, we're establishing any difference between book and fair that has not been amortized yet from when the acquisition took place, is being debited there. So after all that, we need to allocate how much of that goes to the parent and how much goes to the subsidiary. So if we take all of those amounts, the 60,000 plus the 114,000 plus the 35,000 plus the 25,000 and minus the 9,000, $225,000 is what's left to be amortized of those differences between fair value and book value. So 80% of all of those added together and subtracted, which I got an overall $225,000, $180,000 of that will be credited to the investment in pawn company. The other $45,000 will be credited on the consolidated financial statement to that non-controlling interest in pawn company, because that's the portion of that difference in fair value at acquisition that should be allocated to the non-controlling interest. Now, entry I, we need to eliminate the revenue that has been recorded for pawn as a subsidiary. Remember, as the year goes on, when pawn reports its net income to King, King is going to record that as revenue on their normal financial statements and increase their investment account. They're also during the year going to decrease their investment account for that amortization and also decrease that revenue account. So that's where that $64,000 comes from that you see on page 157 in equity and pawns earnings. Now, if you're still not following that, take a look on page 154 and you'll see during 2013, pawn reported $90,000 in net income. 80% of that was allocated to King. King increased the revenue account, increased their investment account for $72,000. But also during the year, King decreased the revenue and the investment account by their portion of that amortization. So 10,000 times 80% or 8,000. So now in consolidation, we're eliminating the equity and pawns earnings account by debiting it, and we're also removing that out of the investment in pawn company for the $64,000. Okay? So that's journal entry I. Journal entry D, we have to eliminate the dividends paid. And that's normal. That's probably one of the easy ones, right? We received $40,000 from pawn company over at King. Although it says $50,000, if you look on page 157, some of that went to the non-controlling, right? So $40,000 will be a credit, and then we will debit the investment in pawn company to eliminate the effect of that journal entry from when we received the dividend. And then the final journal entry we're used to normal consolidation is recording that amortization on the difference between fair value and book value at acquisition. Now remember, we will record, let me see something here. Yeah, all 100% of that because we're reporting all 100% of the assets and liabilities. But you'll see we'll pull some out and put it over to the non-controlling interests, so it clearly reflects our portion of income. So record it as you normally would. Amortization expense, debit for $6,000. Debit interest expense, $5,000. Credit depreciation expense for the $1,000. Then you would offset the equipment by debiting it for $1,000. Credit your patent for $6,000. Credit the long-term liabilities for $5,000. Okay, and we'll see that effect on our consolidated worksheet on page 157. So pretty normal, pretty normal. I'm going to continue here. I hate the way they split this up. So we're going to stay on page 157. I'm going to go to the next slide. There is our consolidation entries again. They're in your book though. Consolidation entry S, A, and I, and D, and E. We've explained all this. What happens though after we finish those normal journal entries? Well, the non-controlling interest in the equity of the subsidiaries must be reported in the owner's equity section of the consolidated statement of financial position. The amount should be clearly identified, labeled, and distinguished from the parent's controlling interest in its subsidiary. Now, before I go any further, let's take a look on page 159. what do we do? Well, if you see there, you can see it says non-controlling interest current year income. First, we have to determine the amount of net income that should be allocated to the non-controlling interest. Well, total net income was $90,000 for the subsidiary. We subtract the amortization on 100% of the company due to the difference in fair value to book value at acquisition. So total net income less that amortization is $80,000. Multiply that by the non-controlling interest of 20%, $16,000 of the subsidiary's net income is allocated to the non-controlling interest. Now take a look on page 157. We will create a line. As you can see there, you create a line, net income to non-controlling interest. So that will be a line item on the consolidated financial statement. Okay. Also, we want to basically eliminate the dividends paid. And we'll take that out of the $10,000 there for the non-controlling interest. Now, when we do that, we've already determined the non-controlling interest in Pawn Company as of the beginning of the year. Remember, we said that. You have to start with that amount. And trying to see where's that. The non-controlling interest as of the beginning of the year, you could look on page 156, would be the 162 plus the 45, 207. So we're going to have 207. Now remember, these aren't debits and credits in the non-controlling interest column. We're just showing you as at the beginning of the year, non-controlling interest in Pawn Company had a value of $207,000. We added to that the net income that's apportioned to them and subtract out any dividends that were paid to them. And the amount their value has as of the end of the year for the non-controlling interest would be $213,000, illustrated there. So when we swing across, the accounts that will be affected normally are affected. So our consolidated totals would be listed there. Notice, we're still ending up, net income is still at $400,000. $400,000 because $16,000 of that is allocated to the non-controlling interest. We've eliminated all net income of the subsidiary that we started with. Because that's the purpose of this. You got to eliminate anything that does not belong on that consolidated financial statement. Well, the non-controlling interest net income does not belong there. The retained earnings it's the King's retained earnings plus King's net income minus King's dividends paid. Then the current assets, and then adjustments for all the other assets and liabilities. Now take a look down in the equity section. When it comes to the common stock, it's King's common stock. When it comes to retained earnings, King's retained earnings. But take a look there. Because we have part of the assets and liabilities that we're reporting, we don't have control over, 20%. That 20% is listed there as $213,000. Non-controlling interest. And that's how we get it into consolidation. So we're just not reporting 80% of the assets and liabilities of Pawn Company on our consolidated financial statement. No, we're reporting 100% of them. But in the equity section is where we distinguish that, hey, we don't own all 100% of them. There are shareholders out there considered non-controlling interest who own some of them. Okay, so here's what your consolidated financial statement would look like. And there's that non-controlling interest in subsidiary. So that is a line item in owner's equity. There is the income statement. Remember, consolidated net income $416,000. Of that, we're not entitled to $16,000 of it. That's going to the non-controlling interest. So we're going to show that. We're going to show how we came up with owner's equity. Here's King's owner's equity. Here's the non-controlling interest owner equity.